Back with our featured guest, Barry Schwartz, for a closer look at tech valuations. And as always, Barry, you've brought us some fascinating historical research, and you've got a response to people who wonder about the Mag 7 being in bubble territory.
Yeah, well, there's been lots of bubbles over my lifetime. Whether it be the marijuana stocks, as people remember in Canada, the dot-com bust, the dot-com boom and bust, junior oil and gas stocks at one point in time. But I see no bubble whatsoever with the Mag 7. Maybe Tesla, but can we show some of these charts?
Sure.
Yeah.
Let's show some of the material that Barry has brought to us. Here's a look at the largest companies in the world. And we see in each case in the bottom left-hand corner, the PE multiple on expected earnings. So Apple, for instance, in the top left of the screen, now trading at 31 times expected earnings. In the bottom right-hand corner of each one of those squares, you get the expected earnings per share growth, which in the case of Apple is 21%. So NVIDIA, you can see it's a multiple of 30 times expected earnings per share growth, 50% this year, and I won't repeat all those numbers, obviously, but there you see. And what, in broad terms, are those numbers telling us?
Well, no one's going to say on an absolute basis that these stocks are screaming by or dirt cheap at 30 times earnings or 29 times earnings. I'm not here to say that, but I'm also here to say that with the type of growth these companies are expected to produce in 2025 and beyond, those are very reasonable valuations, especially considering these companies are in all the right tailwinds going forward: AI, automation, robotics, self-driving cars, you name it. So many opportunities for these companies. They're global businesses, high profit margins, generating unbelievable free cash flows, and selling products and services that the whole world can't live without. Here's a great chart right here, Paul. So what it shows is the free cash flow margins of the largest top 10 stocks over each decade. So if you look at the 2020s, these are companies like the Mag 7, including Visa and Berkshire Hathaway, you name it. They're near 30% free cash flow margins. The top 10 businesses of 2000, 15% free cash flow margins. They're 2 times better.
Right.
And here's the thing. In the 2000s, the largest top 10 companies were trading at crazy valuations. We all remember Nortel and Cisco and AOL and JDS Uniphase. These are companies trading at 500 times earnings, 600 times earnings. That was an insane bubble. And it turned out a lot of those companies either were doing fraudulent things, had no business, and didn't stand the test of time. Many of the largest companies today, Amazon, Apple, have been around for decades. And so we're very, very positive on these companies. I can even argue that they look quite cheap, given that these are the best businesses in the world.
You make an exception for Tesla. Why don't we bring back that first graphic, and we'll just check in on those multiple numbers and EPS numbers on Tesla. There you see it, third square on the bottom row, Tesla, the PE multiple 145 times.
That's pretty silly.
But earnings per share growth expected to be 44%, almost the biggest number on that screen.
Well, the market obviously assumes that Tesla is going to be in such gigantic addressable markets in the future: self-driving cars, batteries, climate change, decarbonization, and Tesla space. So there's just gigantic opportunities. Obviously, it's pricing in a lot of future to happen. So I wouldn't be buying Tesla here. It's kind of a cult stock, 145 times earnings. But the rest of the Magnificent Seven look pretty attractive to us.
What's your advice to investors who have not yet established positions in these stocks, or feel that if they've got positions, they want to enlarge those positions? How do you do that?
Well, I can't tell you the best day you can buy them. I've owned many of them for a decade plus. I think some of the names that are quite attractive here are Google and Meta, both trading around mid 20 times earnings, growing at double digits with perfect balance sheets and focused in all the right sectors, especially AI. I would just say this. Going forward, do you think we're going to be using less technology or more technology? If you believe that AI is going to be a tool that's going to increase productivity for global businesses, then you need to have exposure to these names. And I think the hyperscalers, Amazon, Google, Microsoft, going to be gigantic winners. And these companies are the only ones that can dominate going forward. And we see potential for just exposures to trillion-dollar markets. So we're very excited to own them. In the meantime, they're very profitable. So even if they fall, I don't see long-term how these companies lose. The biggest risk, Paul, is regulation. These companies are gigantic. You saw Biden said all the oligarchs are going to be sitting with Trump at the inauguration on Monday. That's the concern, is that these companies have gone too large. But to grow, they need to get even larger.